Hey, everyone, and welcome back to Tech Fails, the channel where we dig up the dustiest skeletons in the digital closet. Today, we're not talking about a subtle mistake or a minor glitch in a system. We're talking about a disaster so loud, so ridiculous, and so perfectly timed that it became the defining symbol of an entire era of technical insanity. The name? Pets.com. This was more than just a failed startup. It was the quintessential .com bubble collapse, the one that everyone remembers. The brand was known for its adorable, ubiquitous sock puppet mascot, a marketing blitz that was pure genius in its own way. But behind the charming face and the catchy jingle was a technology scandal of financial and logistical mismanagement so profound it's still studied today. It burned through over $300 million in less than 2 years, which was an astonishing amount of money at the time. Pets.com went from its euphoric IPO on the NASDAQ to complete liquidation in a mere 268 days. That's less than a single year for the entire cycle. This is the unbelievable story of how an $11 stock became a 19-cent punchline, a true tale of technical overreach. To truly understand the collapse of Pets.com, you absolutely have to understand the context of the .com bubble. It was the heady, chaotic period of the late 1992s, and the internet was seen as this glittering, untamed frontier with limitless potential. Investors had a completely different set of priorities back then, focused solely on market dominance. They weren't seriously asking, how will you actually make a profit on this business? They were instead asking, how fast can you get a .com in front of your name and dominate the space? The core rule of the bubble was simple and reckless: growth at all costs, no matter the expense. Profitability, a concept now held sacred, was treated as a problem for the mythical tomorrow, something to be worried about years down the line. Pets.com launched its services in late 1998, immediately seizing on what seemed like a perfect recession-proof market. That market was the lucrative, multi-billion-dollar pet supply industry, a segment everyone knew was stable. The initial business model appeared straightforward and highly modern for the time: sell pet food and various supplies online, and then deliver them right to the customer's door. It was essentially an Amazon-style approach, but hyper-focused entirely on pet owners. Consequently, the money started pouring in very quickly from major players. Serious venture capital firms jumped onto the opportunity, eager for a piece of the action and the next big thing. And then came the ultimate validation, the big one. Amazon itself took a substantial stake in the company. Jeff Bezos' company eventually owned up to 50% of Pets.com at one point, which was a massive endorsement. This investment wasn't just about the money. It was the ultimate stamp of legitimacy in the digital landscape. In the .com bubble, if Amazon liked you, you were considered absolute gold, untouchable even. But hiding beneath all the excitement and cash was the core, fatal flaw of the business model. Pets.com had a devastating logistical and economic issue that was simply impossible to overcome. They were selling a high volume of low margin, heavy, and extremely bulky products, which is a triple threat in retail. Think about a giant 40-pound bag of premium dog food, or a 25-pound container of messy cat litter. These are heavy things to move. The company's entire strategy for customer acquisition relied on a deadly combination: aggressive discounting and offering free or at least deeply discounted shipping. They essentially boxed themselves into a corner, financially speaking. Pets.com was knowingly selling merchandise below cost just to compete with traditional brick-and-mortar stores. They also had to fight off a growing crowd of online rivals like petstore.com, accelerating their losses. The internal financials of the company were a catastrophic nightmare from day one. They were operating with negative gross margins on their products, which is never a good sign. This meant that for every dollar in sales they managed to generate, they were actually losing money on the goods themselves. This loss occurred before even accounting for the crippling costs of shipping or their massive marketing budget. Shipping costs were the true killer in this technology scandal. The cost to physically ship a heavy $30 bag of dog food across the country could easily wipe out any potential profit, even if they hadn't discounted the product in the first place. The sheer logistical nightmare of handling these heavy goods simply hadn't been solved by the available technology infrastructure of 1,999. They were trying to do too much, too soon. Crucially, cloud computing did not exist back then to provide scalable, cheap resources. Their CEO later noted, there were no plug-and-play solutions for e-commerce warehouse management. They were forced to hire dozens of expensive engineers and physically build their own massive server farms just to run the website. These were all massive, high-burn expenses that killed any chance of profitability. Pets.com had a fundamental technology scandal that was purely financial, where the simple physics of shipping large items collided with the completely reckless financial model of the .com era. The math just didn't work. If the core product model was a disaster waiting to happen, the marketing was, ironically, a stroke of pure genius. Pets.com needed a brand identity that could cut through the early internet noise immediately. They found that perfect, instantly recognizable image in a brilliant, slightly bizarre, and ultimately catastrophic idea. They created the famous sock puppet dog mascot, a simple and memorable figure. The sock puppet became an instant, legitimate celebrity across the country. It was goofy, utterly charming, and instantly recognizable to millions of people. This lovable mascot was prominently featured everywhere in the media. It even appeared in the legendary Macy's Thanksgiving Day Parade in 1999, reaching a massive family audience. The biggest marketing move was undoubtedly the Super Bowl XXXIV ad in January 2000. Just as the bubble was peaking, that 30-second spot alone cost the company a staggering $1.2 to $2.5 million. The sock puppet was everywhere, appearing on late-night talk shows, national news segments, and in countless print advertisements. The spending was aggressive, intense, and relentless. The ultimate goal was to achieve something called category killer status, to be the one and only recognized pet brand online. They poured over $70 million into marketing alone in less than 2 years. This was a staggering sum. But here is the single most damning statistic of this historical technical disaster, the one number that seals their fate. Pets.com had an average customer acquisition cost, or CAC, of approximately $400 per customer. Think about that number for a moment. They were spending $400 just to get a single customer through the door. This customer would likely place a first order averaging around only $55. Their core customer, who was primarily buying low-margin pet food, would have to reorder repeatedly for years just for the company to break even. This was a timescale the company simply didn't have the cash reserves to sustain. They had undeniably built incredible brand recognition across the country, a huge success in isolation, but the actual advertising campaign had done a terrible job of converting that recognition into profitable repeat sales. They were burning cash for simple awareness, not for necessary revenue. Building brand love does not pay the bills if you are hemorrhaging cash on every single transaction. In February 2000, in the midst of this spending frenzy, Pets.com went public on the NASDAQ exchange. The hype surrounding the IPO was so intense it overcame all common sense. Despite their prospectus openly showing massive, consistent losses, they managed to successfully raise $82.5 million in their initial public offering. The stock, trading under the symbol IPET, debuted at a strong $11 per share. This IPO was, tragically, one of the last major .com IPOs before the market finally peaked and crashed. Just 1 month later, in March 2000, the NASDAQ began its historic decline. The great technical correction and massive .com bust began in earnest. The precious well of endless venture capital dried up almost overnight, leaving companies stranded. With the stock market turning dramatically sour, investor scrutiny suddenly became relentless and unforgiving. The question, when will you be profitable, went from a polite afterthought to an aggressive, urgent demand. Pets.com's management realized they needed a $300 million revenue run rate just to break even, a terrifying target. This was a figure they believed would realistically take 4 to 5 years to hit, minimum. But the market would not give them 4 or 5 years. They didn't even have 4 to 5 months left of runway. As their stock plummeted day after day, their ability to raise the necessary cash to sustain their operations completely vanished. There was no one left to fund their massive losses. The massive marketing spend and the absolutely crippling logistics costs had tragically created a cash furnace that couldn't possibly be extinguished. The whole model was designed to destroy cash, not generate it. The company's aggressive promotions and low prices were designed with the singular goal of growing market share rapidly. But all they really did was hasten the company's death by accelerating the overall cash burn rate. Pets.com tried desperate last-minute measures to save itself. They moved part of their operations to a cheaper location in the Midwest to cut down on warehousing costs. They even acquired a rival, PetStore.com, in a desperate effort to consolidate what little market share they could manage. Nothing they attempted worked to stop the bleeding. The fundamental flaw in the business model was truly terminal. It was a problem of basic economics that no amount of money or marketing could fix in that environment. On the 6th of November 2000, less than 9 months after their euphoric public debut, Pets.com announced the inevitable. It was ceasing all operations immediately. They sadly laid off over 300 employees as they closed the doors for good. Their stock had fallen from its peak of $11 to a harrowing $0.19 per share, a devastating collapse for investors. The company wisely chose to liquidate its assets methodically and return the remaining cash to shareholders. This was a rare ethical move for the era, rather than filing for a messy bankruptcy. Shareholders, the ones who were left, eventually received about 9 cents per share back on their investment. This represented a near total loss of 99.2% for those who bought at the IPO price. The final bitter irony of this technical disaster is what happened to their most iconic assets. The incredibly valuable Pets.com domain name was quickly bought up by their biggest brick-and-mortar competitor, PetSmart. And the famous, once adored sock puppet itself, it was cruelly auctioned off to the highest bidder. It was reportedly acquired by a firm that specialized in selling subprime auto loans. Thus, the ultimate symbol of the dot-com boom was acquired by a company playing in the risky precursor to the next great financial disaster. It was a poetic and devastating end. The story of Pets.com remains one of the most important and brutal case studies in the history of tech fails. 25 years later, it still offers critical, uncompromising lessons for every startup, investor, and entrepreneur. Lesson number 1 is the simplest yet the most ignored. Unit economics always matter. You cannot spend $400 to acquire a customer who only generates $55 in revenue. No amount of venture capital, no matter how endless it seems, can overcome a fundamentally broken financial loop. Pets.com failed to solve the logistical problem of high shipping costs for low-margin, heavy goods. They essentially outsourced their core operating problem to services like FedEx and UPS, and then they chose to eat the entire massive cost themselves. That is not a business plan. Lesson number 2, brand awareness is emphatically not a business model. The sock puppet was a triumph of marketing strategy, but it was a complete failure of business execution. Pets.com proved you could make a brand absolutely famous, reaching millions instantly. But if you don't have a product that solves a problem in a profitable way, all the brand recognition in the world won't save you from a complete liquidation. Building a cult following for a product that consistently loses money on every single sale is just a faster, more expensive way to burn through your initial cash reserves. It accelerates the death. It doesn't prevent it. Lesson number 3, timing is everything in the technology space. It's easy in hindsight to simply label Pets.com as just a bad idea that was doomed from the start. But you have to look at the massive success of Chewy. Chewy, an online pet supply retailer with the exact same core business model, was acquired for $3.35 billion in 2017 and is now a multi-billion-dollar entity. What was the fundamental difference between the two companies? The technology and the market itself. Chewy launched when scalable cloud computing was mature and accessible. Crucially, Chewy benefited from e-commerce tools that were plug and play, and their fulfillment networks were already sophisticated and optimized. Pets.com had to build their entire technology infrastructure from scratch, a massive undertaking. Furthermore, the consumer in the late 2000s and 2010 seconds was far more comfortable ordering everything online, including 40-pound bags of food. The 1,999 consumer still largely preferred the convenience of the local store for an immediate need. Ultimately, Pets.com wasn't a fundamentally bad idea. It was a good idea that was simply 2 decades too early for the underlying technology and consumer behavior to support it. The Pets.com collapse remains one of the most profound technology scandals in the history of the internet. It perfectly illustrates the intoxicating mix of irrational exuberance and completely unsustainable business models. It highlights the fatal flaw of prioritizing abstract growth metrics over the concrete reality of profitability. It was, in the end, a dog that barked too loud and got tragically carried away by the bubble before it ever learned how to hunt. Thanks for tuning in for this deep dive into one of history's most famous tech fails. We love looking at these dramatic collapses. What other doomed .com disasters should we explore next, right here on the channel? Let me know your thoughts and suggestions in the comment section below. Don't forget to like this video and subscribe to Tech Fails, and we'll see you all next time for another deep dive into technical history.